Hi there. If your property is owned through a company, understanding the difference between ATED and capital gains tax could help you.
If a corporate buyer negotiates a property purchase down to exactly £500,000, they owe £40,000 in stamp duty, but paying £1 more, £500,001, rockets that bill to £85,000. Crossing the $500,000 mark triggers the 2026 corporate flat rate, a 17% charge on the entire price. I am here on behalf of Pro Tax Accountant. We specialize in the high-level modeling required to navigate a property tax system that is increasingly aggressive toward corporate holders. Historically, placing luxury residential real estate inside a limited company, or enveloping it, shielded the asset from stamp duty on subsequent sales and allowed non-residents to exploit significant capital gains exemptions. To dismantle these structures, HM Revenue and Customs engineered a targeted legislative gauntlet of indexed annual charges and flat-rate transaction taxes. We are conducting a forensic 10-year comparison of the 2026 tax landscape, pitting personal property ownership directly against the corporate route. We will evaluate three specific variables: the annual ATED compliance cycle, the Section 24 income tax differential, and corporate capital gains extraction. In 2026, data dictates structure. A single oversight in acquisition modeling can eliminate a decade of projected yield. This split-screen ledger tracks the total cost of ownership for a £1 million investment property from 2026 to 2036. We begin at year 0, acquisition. Personally, progressive bands and the 5% surcharge bring the acquisition tax to £93,750. Corporately, the 17% flat rate applies to the entire purchase price, creating an upfront tax bill of £170,000. To drop the corporate rate back down to standard levels, the company must claim property rental business relief in the stamp duty return. This relief depends on strict operational facts. The property must be commercially let to an unconnected third party. Any personal use by a connected person, such as a director or family member, invalidates the claim. This relief is not automatic. Failing to explicitly claim it at completion makes the 17% charge irreversible, as HMRC does not accept late claims outside the original return window. The corporate route begins with significant compliance risk. Investors must secure proof of relief eligibility before they exchange contracts. During the holding phase, the investment becomes a balance between annual income tax savings and the overhead of mandatory compliance. For many landlords, the primary incentive for incorporation is the ability to bypass the Section 24 interest restriction. Personal landlords receive only a 20% basic rate tax credit on mortgage interest. For a higher rate taxpayer, this means paying tax on rental income that is actually being used to service debt. In contrast, a company deducts 100% of its mortgage interest as a business expense before calculating profit, which is then taxed at the 19 to 25% corporation tax rate. Offsetting these savings is the annual tax on enveloped dwellings, or ATED. ATED is a yearly charge on properties over £500,000. In 2026-27, a property up to £1 million carries a $4,600 fixed cost. Indexed to the Consumer Price Index, this charge rises annually, creating a continuous drag on net yield. Even when a company qualifies for full relief that reduces the actual tax to zero, the reporting requirements remain mandatory. The 30 April deadline for the relief declaration return is absolute. Failing to file triggers fixed penalties and daily fines, even if the property is commercially let. Successfully holding a corporate property requires flawlessly executing annual ATED compliance to prevent fines from eroding the Section 24 tax savings. We now reach year 10, the exit. The property is sold for £1.5 million, realizing a capital gain of £500,000. This waterfall chart shows how the two ownership structures handle that profit. Personally, after the £3,000 allowance, the 24% capital gains tax secures the owner's net cash. Corporately, the company first pays 25% corporation tax. Extracting the trapped capital triggers a 35.75% dividend tax. Ultimately, the final corporate cash is significantly lower. When you compound the 25% corporation tax with the 35.75% dividend tax on the remainder, the combined effective extraction rate for a corporate property gain reaches 51.81%. This exit penalty often determines whether incorporation is a viable strategy or a financial error, as it can offset years of initial income tax relief. Many landlords in 2026 are attempting to de-envelope, transferring properties out of corporate structures and back into their personal names. This movement is largely a response to the 51.81% effective tax rate realized at the point of sale. However, the act of de-enveloping itself triggers immediate liabilities. Moving the property out of the company is treated as a dispensal, which triggers the corporation tax and stamp duty the owner is trying to avoid. For properties that have appreciated heavily, this upfront tax cost can exceed the present value of any future ATED or dividend tax savings. Unwinding a corporate envelope requires a multi-decade net present value calculation. It is a decision that must be guided by the numbers rather than a reaction to current tax rates. We can map the final decision onto this matrix, analyzing how mortgage leverage and hold time dictate the optimal structure. Corporate ownership is most effective for highly geared portfolios of 6 or more properties, with a hold time exceeding 15 years. In this scenario, the investor reinvests rental profits to expand the portfolio. By retaining the capital, they compound their gains at the lower corporation tax rate and delay the 51% extraction penalty indefinitely. Conversely, personal ownership generally wins for cash buyers, investors with small portfolios, or those planning short-term disposals. These owners avoid the 17% stamp duty cliff edge, bypass the ATED compliance cycle entirely, and secure the lower 24% capital gains tax rate. The intersection of ATED, corporate stamp duty, and extraction taxes makes property holding a high-stakes modeling exercise. A single structural error can result in significant financial loss. This analysis is for educational purposes and does not constitute formal financial or legal advice. UK tax law is subject to change and specific to individual circumstances. For precision modeling before you acquire or restructure property, contact the team at Pro Tax Accountant. You can reach us by phone, email, or through our website to evaluate your strategy. Subscribe for further technical breakdowns. In the 2026 property market, the data dictates the structure. We will see you in the next one.